Good morning. Selling the business versus selling the real estate, and what owner users must know before planning their exits. So, if you own both your operating business and the building it sits in, your exit strategy is a little more complex and more valuable too than you think. And most owner users don't lose money because of market conditions. They end up losing money because their sale was structured incorrectly. So, for business owners in Katy, Fulshire, and West Houston, understanding how to sell a business and commercial real estate properly can mean the difference between a few outcomes. And the one we all want is a clean, maximized exit, or you end up with a stalled transaction with discounted pricing. So let's break this down a little more clearly. So the core issue is there's two assets, but there's really one decision. And when you own both, the operating company as well as the commercial real estate, you're really in control of two separate but interdependent assets. So the mistake that most folks makes is treating them like they're unrelated. And the truth is they're not. So the business is going to support the building, and the building supports the business. And the financing on each affects the other. So why separating them often kills value. The first reason is there's the buyer risk problem. So if you sell the real estate without securing a long-term lease from the business buyer, investors could see vacancy risk, and rates could rise. And in doing so, the value could drop. In a vacant building tied to a recently sold business gives off an air of perceived instability. So, two is the financing breakdown. And business buyers typically will use an SBA 7A loan, an SBA 504 loan, or sometimes the seller's willing to finance it. And the real estate buyers will often use bank conventional commercial loans or debt service coverage ratio loans based on the leases, or a bridge loan just to get the property acquired. But if you're trying to sell the building separately, you're going to eliminate SBA financing for the real estate, that is, but which often is going to provide the highest leverage and the best terms for your owner users. So it brings you the more buyers. And you don't want to shrink your buyer pool significantly, is the point. Number three is emotional versus financial buyers. So really those are the two categories. And the business buyer is really looking for cash flow, for goodwill, and a customer base. Whereas a real estate investor cares more about the NOI and the lease strength in the buildings and the credit tenant profiles. So the point is, if these don't align, you're going to create friction for yourself. So let's look at some financing implications that owner users must understand. And the most powerful exit structure for many owner users is combined sales using SBA 504 or 7A financing. And you may be asking yourself, why? Well, that's because SBA financing is going to allow for up to 90% of the total project's financing costs. It allows for the business and the real estate in one transaction. And it will give your client or your buyer the longest amortization and the lowest down payment requirements. So what this does is it dramatically expands your buyer pool. Now, if you separate the assets, and you can, it could force higher down payments on the people who are buying the business from you. It could reduce the leverage that's completely available to them. And it could also require stronger credit borrowers and more liquid borrowers, which ends up narrowing your qualified buyer pool. And that usually translates into lower pricing. So that's how they all work together. But there are cases when separating them does make sense. And these are the exceptions that you might want to think about. So you may consider splitting the sale if you really want long-term passive income for the building, and that's your real objective. Or the business is unstable, but the real estate is strong. Or the property has redevelopment upside. And in that case, you may want to complete a 1031 exchange. So in these cases, you must structure a strong lease agreement with the business buyer at market rents and make sure they have a clear operating history. Now, without that, investors are going to discount their offerings heavily. So let's talk about how to structure a clean exit. And here's the disciplined approach we use at the Viking Enterprise Team. And the first step is a valuation strategy. So we're going to value the business based on EBITDA or SDE, and then value the real estate based on the NOI and cap rate. We need to look at how the lease structure affects the property value is the point. And then step 2 is financing mapping. So we need to identify which loan structure is going to maximize your buyer pool, but also their leverage, so less cash needed, and also with the certainty of closings. So that way we don't get into a contract and have problems. But often SBA-backed financing is going to win here is the point. And step number 3 is your exit alignment. And we need to determine if you want to sell both together or sell the business first with a lease, or sell the building to investors with a lease back from yourself, or if you just wanted 1031 into replacement property on the building. And your structure should align with your tax strategy, your retirement goals, but as well your cash flow needs and your risk tolerance. So let's take a look at a real world owner user example. A medical office owner in West Houston who owned their practice and then owned the building. Well, they were considering selling the building alone at first. And after analysis, we restructured the deal, sold the business and the real estate together. And we were able to use SBA financing, and we brought them the biggest buyer pool as part of that transaction, but also with improved pricing. We delivered a clean close. And that's strategic exit planning and not reactive selling is the bigger point. If you own both your business and real estate, here's some thoughts. You're really not selling one asset. And what you are selling is a capital structure to somebody. And then that structure is going to determine the value of what you're offering. So if you're in Katy, Fulshire, or West Houston and considering an exit within the next 1 to 3 years, the time to plan is now, not right before you list. So give me a call. Let's build your exit strategy the right way. My name is Bill Rapp. My website is HoustonRealEstateBrokerage.com. Please visit there. We can chat more about your situation. Have a good day.